Good morning. Welcome. It is 6 a.m. to half an hour before the market opens on February 2nd. We had Apple's earnings, we had Amazon earnings, we had Meta earnings. Amazon and Meta did quite well, so they have a net pulling up effect on the market, but Apple did not do so great. So that is dragging down. But net, we should be up. And last night, the futures were up quite a bit. So we'll see if that held overnight and take a look how futures are opening this morning. Okay, so we've got S&P not really moving too much, about 20 basis points. Dow is down roughly 20 basis points, and the Nasdaq is up about half, a little over 50 basis points. So we are definitely up on the Nasdaq, not really big, but still significant. And the S&P and the Dow are kind of just random. So let's take a closer look and see how that developed. If we look at, okay, so there is a big drop right here, right at 5:30. So there's probably a report that came out right then that put cold water on all the enthusiasm that we had in the futures markets. So overnight, you can see with all the earnings, net, it was very positive, stayed flat all the way until that report. So we were much higher in those futures. We were this splashed a lot of cold water. So let's see which report that was. It's continuing to go down. Let's see at our economic calendar. 5:30 was the employment situation. See what happened over here. Non-farm payrolls, much stronger than before, much stronger than consensus. Much stronger than consensus. Employment rate came in pretty much on the dot. Private payrolls, much stronger. Manufacturing payrolls, much stronger. All the payrolls are at least twice as much as what they thought they were going to be. So this is the big surprise. So why down? Is employment good? Well, employment is inflationary. When more people have jobs, they have more money coming in, then they tend to spend. And if they spend, then that's increased demand. And if we have increased demand with the same supply or limited supply, this is the same thing that happened when we had all of those supply chain issues during COVID. That's what caused the initial spike in inflation that the Fed kept saying was transitory. They said, well, it's transitory. But obviously it was not transitory. And so this is the same type of inflation that we fear when the employment situation is very strong. So this is, like I said, at least twice as strong as expected. So that's highly inflationary. So that's probably why everyone is fearful. And so let's just see if we can take a look at the pre-market and see where everything is looking like it's going to open up. Now you can see here that we're going to open in the S&P. SPY looks like it's very close to the previous close, which is still below that psychological resistance. When we looked last night, according to the futures, and much earlier in the pre-market, so about an hour and a half ago, this is well above. It looked like the SPY was going to open at the all-time highs. So that employment report really changed a lot. QQQ opening just at the highs of the previous day. So not yesterday, but the day before. So with all of the at the earnings news that we had, we would have expected this to be a lot higher. And again, a couple hours ago, this was much higher. So we were going to evaluate that very carefully. We'll see how today plays out, but today is going to be very telling if we can continue along this uptrend or we might start pulling back. So right now, I would be very cautious, just given what I've seen so far. I definitely want to keep my hedges in place. Now is not a time to take those hedges off. Now is the time to just keep them in place. And if we see strength, it might be a good idea to sell into that strength, take profits on our positions, especially tech positions. Yesterday in the aftermarket session, we talked about how Staples was starting to lead in the last week, and that was very defensive. Well, that's probably some insiders, some market makers, some institutions sort of know what's going on. They already know where they're going to move and allocate their money. So their plan, if there's strength in the tech, would be to start taking profits. So we're going to do the same thing, or at least I'm going to do the same thing. And if we've invested so much money ever since October that there's not going to be getting around, which means in the analogy of the business world, we say that inventories are full. If I have a warehouse, my warehouse is full. I don't have any more space. I don't have any more money to buy stuff to put into my warehouse, and my warehouse is packed. So I need to start making space in my warehouse, and that's a sell. That means I have to sell, start bringing my cash back up, start making space in my warehouse so that I can buy again. So that tends to happen when a market has gone up 20 to 25%. So let's just take a look at a few times in history and see if I know what I'm talking about. Okay, so let's go from here to here. What was it? This was COVID. That doesn't really count because it doesn't count because it was very special circumstance. So we go here to here. That's 21, 22, 22.6%. And then we have a pullback. Our warehouses are full. Then we clear our warehouses. When we go over here, 21%, our warehouses are full. We clear out our warehouses. Not all the way like this one, but we make space. And then we pulled back into that MA200. And then we did it again. This time we went a little further, 30, 34%. And then we pulled back all the way into the MA200. And then now we're doing it again. Now we're now at 20. Well, I probably need to get more precise. I think this line is getting in my way, so I'll move that temporarily. 25%. So it's an appropriate time for us to have a pullback, for us to clear inventories. There just tends to be not that much cash left available when we've had a run up at 20+%. And then we start to get sell-offs. So what happens is a lot of people, they notice something and I would say, hey, why don't you trade news? I usually tell them I completely ignore the news. I don't tend, because news will have a very temporary effect. The temporary effect is a couple of days. And insiders, media is really just a tool for insight. Okay, if I was a business person, if I was a retail seller, say I'm Target or Costco, or not really Amazon because they don't do it, but just a normal retailer. If my store is packed with inventory, this happened to Target a couple of years ago. We had a supply chain cut off and everyone ordered a whole bunch of stuff. And then Target their warehouses were packed with stuff when the supply chain came back online and everything was available again. And they go, crap, our warehouses are full. And now everyone is able to get stuff. We bought all this inventory because we were afraid we would continue to not be able to get stuff. So what did they do? Everything went on sale. Everything went on sale and they cleared out their inventory. How did everyone know that everything was on sale? Media. They started telling people. It was on Yahoo News. It was on CNBC. It was on the regular news. It was all over the place. And they utilize the media in order to clear out their inventory. Insiders in the stock market and in the equities markets do the exact same thing. My inventories are full. Guess what is going to be printed today if the SPY hits that all-time high. It seems a lot less likely. 2 hours ago, it seemed very likely because the futures, the pre-market indicated that it would. But right now we're right back down to yesterday's close. But just say that we had opened up at that high and then we traded up higher. What would the headline be? The headline would be S&P at all-time highs. S&P continues its amazing run. And then all the headlines would be talking about how bullish this market is. And that's when insiders start to sell. And so for a couple of days, yeah, it will keep on going up because the news is driving buying from the retailers. So you got to ask yourself, are retail traders buying or are institutional traders buying? And I guarantee you at the top, when there's a whole bunch of headline news that is all positive, that's when institutions are selling to the retail buyer. All the buying is happening as a retailer. And therefore, after a couple of days, we start going down. And then it looks like the media is always wrong. How many doomsday headlines are there when we're down here? Oh my God, all the bears, it looks like all the bears are right. We're going to go to lower lows. We have JP Morgan, Goldman Sachs, huge banks telling us that they're revising their outlook and that they're expecting lower lows and all these doomsday headlines. It's the job of the analyst to put out reports and to put out media stories that allow the traders of their bank to get into the positions that they want to get into. Not to report on what they're, well, maybe they are reporting where they think that it's going to go, but their job, the reason why you put something into the media is to influence the behavior of the media consumer, which is the retail trader. So a bank, one division of the bank will put out a news that looks really negative, and then the other division of the bank is, I'm going to buy a whole bunch of, this is going to call it a selling frenzy, I'm going to buy it up. And then the other way around, the one division says, hey, everything, all-time highs, everything's super bullish, it's amazing. And then the other side of the bank is, this is a perfect time to start clearing my inventory. That's how the financial media and financial institution industries work, and they work hand in hand. Some people say, there's a conspiratorial twist to it. Whether or not there is, that's how it works. It doesn't really matter if there's conspiracy behind it. That's how it works. That's how this system, that's how those two industries play off of each other. So that's why when you go back and you look at the news headlines, you're like, well, that was wrong, that was wrong, that was wrong, that was wrong. It was right for a couple of days. And the media doesn't care beyond that. They just want people to consume their news. So news is only right for a couple of days. So if we get a really strong day today, or if there's any sort of sign of strength today, which there is in the tech, it's just not super strong. We're just going to go back into this range. Maybe if things are really strong, then we will get those all-time highs. But for me, that is a sign to start taking profits and to keep my hedges in place. I don't know for sure that the sell-off is going to happen right here. It could have happened right here, it could have happened right here, but a little less likely because we had only gone up 15, and here was a little bit more likely at 21%, but now that we're at 25, 26%, then it's that much more likely. Remember before, we always saw between 20 and 30%. That's when we start to clear out our inventories. Why? Because that's just how much money institutions have. If they could bring it even higher, they would bring it even higher, but they're probably running out of money. So, and the slight caveat to that is, well, it wasn't always 20%. It was a little less than that many years ago, but we have more and more retail traders, and especially after COVID and quote unquote free brokerages like Robinhood, that brought a lot of money into the markets. And actually, it was a very tricky thing by the financial industry was to get away to start offering free trades. A lot of brokerages now in the United States offer commission free trading, like Robinhood, commission-free trading, or very, very cheap priced options trading. Options in the United States used to be $3, $4 per contract. Now it's like 60 cents, 50 cents per contract. That attracts a lot of money into the market, which means that there's more shoppers. And if I'm a retailer, I love it when there's more shoppers. There's more people to buy my stuff. There's more people to buy stuff from. So these runs upward have tended to last longer because now there's more cash in the system. So now we used to say 15 to 20%. Now I say 20 to 25%, but based on evidence, just in the most recent 2 years, looks like 20 to 30% actually. And right here, we're at 25%. So it's an appropriate time. Could it go back up to 30%? Yeah, absolutely. So that's why I say we're starting to take profits, but I still want my portfolio leaning positive. That's the trend. And until that trend breaks, that's when I'll start flipping, maybe a slight bearish bias, but not entirely bearish because it's not a downtrend. It's just a pullback or a correction. It might become a downtrend or a bearish trend, but until it does, I'm not going to turn my portfolio fully leaning bearish, just partially leaning bearish. For now, this is still an uptrend. I should get that purple line back. This is still an uptrend. We bounced off of that EMA 20. We bounced off of this purple line. So it's still an uptrend. I'm just saying that it's a good time to take profits and maybe enter into baby positive positions, but I wouldn't be doing it in QQQ. I would be doing it in consumer staples. Look at that. Look how strong that is. That looks nothing like QQQ. So we want to be careful. We want to know how Wall Street works, how the financial institutions work, how the financial media works. And we will see how today turns out. It'll end the first week of trading, not first full week, but at least the first couple of days of trading in February. You're going to see all sorts of headlines like, oh, we closed the first few days of February strong, or we closed it weak, or we reached an all-time high. Whatever it is, it's some sort of spin to try to influence the retail trader, and just always be aware of that angle. And when there's a lot of buying, who's buying and who's selling? Or when there's a lot of selling, who's buying and who's selling? Is it the retail guy or the institutional guy? Right now, if there's going to be a lot of buying, it's going to be the retail guy. So if there's a strong surge in buying, for me, that's a warning sign. If it's just mild, if it's just normal, like yesterday was kind of normal, these days are kind of normal. This one is a large volume and somewhat large bar, but not that big. So I would still consider that normal. But if I get a green bar today, that brings me all the way to the all-time high. That would be a pretty big bar. And then we'll see. If there's a lot of volume associated with it, then to me, that's an indication that insiders are beginning to clear out their inventories. They won't be done clearing out their inventories. They're beginning. So it could take a couple of weeks for them to finish clearing out their inventories. And then we'll see this QQQ start dropping. So we don't know exactly how long it'll take. And I don't even know if it's going to start today. It would have been a lot more convincing if this employment report hadn't come out and then we were going to open up at these all-time highs. Then I would say almost for certain it would have started today. But we'll see. That employment report really changed the picture. And we're going to see how we close this Friday, and then we'll have the weekend to digest to see what we're going to play the following week. So I've talked way longer than I have in a while in the pre-market. We're 10 minutes away from the open. So I will leave you guys to prepare, and then I will see you in the aftermarket.